Bank of Canada's done its thing, dropped rates. Where are we at for every rate? Where are we at? Okay, so let's analyze. The Bank of Canada dropped down to 3%. So this means that's the Bank of Canada, though. The Bank of Canada only lends money to banks. They don't lend money to people. So there's commercial bank prime, and the banks react to the Bank of Canada's rate reset. And today, our commercial bank prime is 5.2. So let's break down the categories. We've got home equity lines of credit, a HELOC. Some people call it different things, home plan, whatever, flexi line, whatever. Different lenders call it different things. It's a line of credit attached to your house. It's secured by your house. And that rate is somewhere between 5.2, which is commercial bank prime, and 5.7. If you're paying more for 5.7, well, you're probably getting fucked. Yeah, no, you shouldn't pay any more than 5.7 unless you're with a B lender. But if you're with a bank, if you're with one of the big banks, you should be at no more than 5.7 and maybe less. I mean, there's starting to be more and more action in less than prime plus a half, prime plus a half a percent. Starting to be more discounting in there. So pay attention to it. Make sure if you're no more than prime plus a half, you should start by trying to negotiate with your bank to get it down because there's some better deals available. Nothing better than 5.2 though. So variable rates. Variable rates are a discount from prime rate, from the bank prime, 5.2. So they're a discount of anywhere between 0.65 and 1.15%. Now, where's the differences coming from? So let's say prime less 0.65 is a mortgage on a rental, on an investment property. But prime less 1.15, that's a good rate, by the way, very good rate. That's on a CMHC purchase, a low down payment, less than 1.5 million. It's got a bunch of whole other things that you got to do and hit certain ratios. It's got to be more or less perfect. That's prime less 1.15. So your variable rates available today for renewal, or for the case of that 1.15 for purchase, they range from 405. Yeah, you could have a 405 variable rate to 4.55. And let's just note, there's one other product advantage. There's a product advantage to variable rates, is the guaranteed penalty. 3 months interest. That's it. No other calculation, nothing else to think about. It's just 3 months interest. Oh, but Ron, yeah, my fixed rate's like that. No, it's not like that. I guarantee you it's not like that. You're the bank person who got it from me have sort of muttered that under their breath, but no. You have something called an interest differential penalty on any fixed mortgage. And I've seen those go as high as 3% of the mortgage. That's an outlier. That's rare, but I've seen an interest differential penalty run to 3% of the mortgage balance. Yeah, huge, damn well huge, okay? All right, let's talk about fixed rates. Fixed rates were sort of down in the fall, September, October, went up. Fixed rates started going back up again. We saw fixed rates at the end of the year last year in late December. Fixed rates were running up around as high as 4.59. Every rate was in the fours, mid fours, all kinds of rates. That's down. Now, again, fixed rates, nothing to do with prime rate. They're to do with Canada government bond yields. And those have come off. They've come off substantially just in the last 10 days. So we are seeing 5-year fixed as low as 3.99. You're probably going to see some 3.89 soon if this keeps coming the way it is. But 3.99 is achievable on a 5-year fixed. Again, that is one of these CMHC purchase mortgages. Small down payment, under 1.5 million. Got to be very tight on the debt ratios. So not many people have. In Ontario, that's about 8% of 6 to 8% of administration, depending on the time of year, of origination, depending on the time of year. So yeah, it's a small subset. In Alberta, it's a lot more. In Alberta, it's still about 20% of all new purchase mortgages. But that's the rate. But the good news is, for a conventional mortgage that's not CMHC, there's a lot of 4.19, 4.14. That's around for a 5-year. 3-year is about 5 bips higher, maybe 404, 409. Again, that's for a CMHC purchase. For 24, 419, maybe 414 again on a 3-year fix just for regular transfer, renewal, refinance, you name it. So it's come back down into the low fours. That's where we're at today. Function of bond yields. Why are bond yields falling? Lots of reasons. Quantitative tightening ended today. Yesterday, sorry, last week. Last week, I got my dates right. Last week, quantitative tightening. Don't bother worrying about it. But that ended. That's a bit of a stimulus to lower bond yields. But also, there's just so much volatility and chaos in the international sale of government bonds today. I'm sure if I got a bond salesman in here, they'd give me an answer, but I don't have an answer today. Just telling you those rates are definitively lower than they were a month ago, like significantly. So what is the final summary of all this? Final summary of all this is if you got a renewal notice for February last month in January, it's probably going to be higher than you could get today. So get out there, get shopping, and push back on those rates that have come down. If you got a renewal letter in January 1st for a renewal in the middle of February, there's room to push back on those rates. You can negotiate with your bank and push them down. So get at it. If you got a renewal, you got to shop, you got to push, you got to negotiate, you got to threaten almost to leave. That's important to do right now.